In the accumulation phase of your financial life, your job is pretty straightforward. Earn money, save consistently, and invest it wisely. It is all about growth. But when you start to get close to financial independence or retirement, things start to change. You're no longer accumulating wealth. You're now withdrawing, living off your investments. And that requires a completely different mindset and a different strategy. So how to best approach this phase? Let me share with you 5 simple steps to help you build a safe withdrawal strategy. One that gives you peace of mind, keeps your money working for you, and helps you avoid the biggest pitfalls people make when trying to live off their investments. Step 1 to building your safe withdrawal strategy. Lay the groundwork early. You have to recognize that your withdrawal strategy does not begin the day you retire. No, it actually starts years prior to you actually retiring. And the better you can plan ahead, the better you will be positioned to confidently retire. So how early should you start? Well, to be safe, I say at least start thinking about what your withdrawal can look like 10 years out. And for sure, at least 5 years out, start working on critical activities. Let's talk about some of those critical activities. First critical activity, start building out your retirement budget. Start to think about how much you actually spend today and how much you expect to spend in your retirement years. Some best practices include tracking your current expenses for a few months, identifying which costs will go away in retirement, like commuting or work-related expenses, and which might increase, like healthcare or travel. Begin adjusting your lifestyle to align with your expected retirement spending. This not only gives you clarity, but also helps ease the psychological shift into a fixed income phase. Second, start to build a 2 to 3 year cash buffer. This is money you can live on without touching your investments during market downturns. Good options for this include a high-yield savings account or a simple money market fund. This buffer becomes your cushion, especially during bad market years, protecting you from selling investments at a loss. Third critical activity, gradually start shifting your asset allocation. If you've been 100% in stocks during accumulation, that's fine for growth. But retirement introduces new risks, especially sequence of return risk, which we'll cover later. Start by introducing bonds to your portfolio. Not a full 60-40 or 70-30 split immediately, but maybe 10 to 20% in a bond fund like VBTLX or BND. This helps you get used to a different behavior of bonds versus stocks and begins to reduce your portfolio's volatility. Fourth, this is the time to start Roth conversions. In the years between when you stop working and when required minimum distribution RMDs kick in at age 73, you may have lower taxable income. This creates a perfect opportunity to convert some of your traditional IRA or 401k funds into a Roth, reducing your future RMD burden and giving you tax-free income flexibility later. And fifth, start looking into your Social Security. Specifically, think about when you'll claim your benefits. While you can start early as age 62, every year you delay up to age 70 increases your monthly benefits by roughly 8%. For many people, delaying not only boosts lifetime income, but also acts as a form of longevity insurance. Plus, waiting can create a window of lower taxable income, perfect for executing Roth conversions or managing capital gains more strategically. The earlier you understand your claiming options, the better you can integrate them into your broader withdrawal plan. Bottom line, recognize that planning early gives you more control, more options, and a smoother transition into the withdrawal phase. Step 2 to building your safe withdrawal strategy. Choose a sustainable withdrawal rate, essentially a framework for how much you can withdraw from your portfolio without risking its complete depletion. Now, the classic rule of thumb is the 4% rule. It comes from the Trinity study, which found that if you withdraw 4% of your portfolio in your first year of retirement and adjust for inflation each year, your money should last at least 30 years. So if you have $1 million saved, you could safely withdraw about $40,000 in your first year, then increase that amount with inflation each year after. And you would apply this rule to every dollar you have invested, regardless of where it's held. 401k, Roth IRA, taxable. It is a portfolio-wide guideline, not something applied account by account. The idea is to look at your total investable assets and determine your annual withdrawal target using that percentage. We'll discuss the most tax-efficient way to withdraw in the later steps, but for now, just focus on understanding the big picture number. How much you can sustainably spend each year without prematurely depleting your portfolio. But I want to introduce another nuance to this withdrawal rate. A recent research from Morningstar suggests that in today's lower yield environment, a safer number could be between 3.3 and 3.7%. This adjustment reflects current expectations for future market returns, interest rates, and inflation, factors that have shifted since the original 4% rule was developed in the 1990s. This matters because a lower expected return environment means your investments may not grow as quickly as they did in the past. If you withdraw too much early on, Your portfolio might not recover from the market downturns or keep up with inflation over a 30-year retirement. But I've also seen other studies that actually quote a higher withdrawal rate. For example, Bill Bengen, who originally introduced the 4% rule, has since updated his research to suggest that under ideal conditions and with a more diversified portfolio, a withdrawal rate of high as 4.7% could be sustainable. So the big question, which should you use? Here's my recommendation. Use the 4% as a simple starting point. It's easy to calculate and it gives you a ballpark number to plan around. If you're more conservative or you expect lower market returns, lean closer to 3.5%. If you're more aggressive, lean closer to 4.5%. But no matter what number you choose, flexibility is the key. The most successful withdrawal strategies are dynamic, not rigid. If the market performs well, maybe you give yourself a raise. If the market drops significantly, you tighten up spending for a year or two. You can also use frameworks like guardrails or probability of success modeling to guide your choices. Guardrails adjust your withdrawals based on market performance, raising them when your portfolio grows and tightening them during downturns. Probability of success tools, like those found in retirement calculators or financial planning software, run thousands of simulations to estimate how likely your plan is to last through retirement, helping you course correct before problems arise. But I say you don't need to overcomplicate this. Start simple. Use the 4% as a starting framework and adapt as needed. Now, before we go on, I do want to take a moment to pause and talk about the elephant in the room. Because as much as all these things that we're talking about in this video make sense, the truth is that many people get stuck. They understand the 4% rule conceptually. They heard about the guardrails and flexibility, but when it comes to actually applying it to their own situation, their specific mix of accounts, their Social Security timing, their tax bracket, their actual spending needs, suddenly it's not so simple anymore. And that's completely normal, because withdrawal planning is not just about picking a percentage. It's about coordinating multiple moving pieces that all affect each other. Should you start Roth conversions now or wait? How much should be in cash versus bonds? When should you claim Social Security? How does your withdrawal rate change if you have a pension or rental income? What if the market drops by 30% in year 2 of retirement? As you can guess, these are not questions with one-size-fits-all answers. That's exactly what we work through inside the Financial Tortoise community, taking the framework and making it work for your specific situation. Here is what you get inside. Access to one-on-one coaching sessions with me, where we can work together to build out your personalized withdrawal plan. Step-by-step courses like Investing Simplified that walks you through investing pitfalls and sample investment portfolios. Access to monthly live Q&A calls, where we dive deep into key topics like tax optimization strategies, investment allocation, and retirement planning. A private forum connecting you with other like-minded professionals navigating similar transitions. Premium tools like Monarch Money to track your money and your progress. Our quarterly book club keeps you learning without the overwhelm. Plus, we just launched the Financial Tortoise AI Assistant, your 24/7 financial planning companion. It's trained on everything I teach, so you can ask questions like, how should I adjust my withdrawal rate if the market drops by 20% in my second year of retirement? And get instant, personalized guidance. However, to maintain the high quality of support each member receives, I only open enrollment a few times a year. So join the waitlist today at financialtortoise.com/community and get priority access when doors open again. Many members have completely transformed their financial lives through this community, and with the right guidance and clear plan, you can too. You deserve it. I would love to see you inside. Alright, with that said, let's get back to the video. Step 3 to building your safe withdrawal strategy. Create buffers to manage risk. As I alluded to earlier, retirement introduces a unique danger called sequence of return risk. This happens when the market performs poorly early in your retirement and you're forced to sell investments at a loss to fund your living expense. Even if the market averages a solid return over the long run, the order of those returns can make or break your retirement success. And why is this so devastating? Because when your portfolio drops and you still withdraw a fixed amount, you're selling more shares at a lower price. And those shares never recover. It's like pulling fruit from a tree during a drought. It cannot regrow as robustly. Studies show that most portfolio failures under the 4% rule occur when negative returns hit in the first 5 to 10 years of retirement. Thus, avoiding deep losses in those critical years is critical. And that is why buffers are essential. We already talked about building a 2 to 3 year cash cushion in step 1 using high-yield savings accounts or money market funds. This cash is not there to grow. It's insurance, allowing you to avoid touching your investments during a downturn. But let's take it a step further with the bucket strategy, a framework designed specifically to protect against sequence of return risk. Here is a simple 3-bucket framework. Bucket 1, 1 to 3 years of living expense in cash. This gives you a short-term buffer. Bucket 2, 3 to 10 years of intermediate term stability in bonds like VBTLX or BND. These provide moderate growth with lower volatility. Bucket 3, 10 plus years. The rest of your portfolio in long-term growth stocks like VTSAX or VTI. When markets are strong, you draw from bucket 3 and refill your other buckets. When markets are down, you stop selling stocks and draw from bucket 1 or 2 instead. This structure gives your stock investments time to recover before being touched again. And for even more protection, consider the Bond 10 strategy, gradually increasing your bond allocation in the years leading up to retirement, say going from 90-10 to 70-30, and then dialing it back up once you've cleared the riskiest early retirement window. This lets you ride out volatility with less impact. Now, you don't need to be perfect with these strategies, but implementing any of them greatly reduces the chances that a bad market derails your retirement plans. The key takeaway? Buffers are one of the best defense against future uncertainties. Step 4 to building your safe withdrawal strategy. Sequence your withdrawals tax efficiently. Each account type has different tax implications, and how you sequence those withdrawals can dramatically affect your lifetime tax bill, portfolio longevity, and even Medicare premiums. The general order of withdrawal should go as following. Taxable accounts first. These typically can have lower tax impact, especially if you're selling long-term capital gains or using a tax loss harvesting strategy. Drawing from these accounts first helps preserve the tax-deferred growth in your retirement accounts. Second, traditional IRA or 401ks. Withdrawals here are taxed as ordinary income. Waiting to use these accounts allows your savings to grow tax-deferred longer, but taking some money out before required minimum distribution start can help reduce future taxes. Finally, third, Roth accounts. Roth IRAs and Roth 401ks grow tax-free, and withdrawals are tax-free as well. Leaving them untouched as long as possible allows you to maximize that tax-free compounding. They also don't have RMDs, making them a powerful asset for late retirement or as an inheritance tool. And remember, the sequence is not just about saving taxes for 1 year. It's about smoothing out your tax exposure over multiple decades over your lifetime. Now let's dig a little deeper into RMDs. Require minimum distributions because they can quietly create a massive tax problem if you're not proactive. Starting at age 73, the IRS mandates that you begin withdrawing a certain amount each year from your traditional retirement accounts, like IRAs and 401ks. Uncle Sam wants his taxes. And as mentioned earlier, these withdrawals are fully taxable as ordinary income, and additionally, the amount you're required to take increases every year. Thus, RMDs can push you into higher tax brackets just when you're trying to enjoy a steady retirement. They can also trigger IRMA, which stands for Income-Related Monthly Adjustment Amount, basically a penalty that increases your Medicare premiums if your income crosses certain thresholds. So to manage your RMDs wisely, let's keep these best practices in mind. 1. Take your RMD before doing a Roth conversion in the same year. The IRS requires RMDs to be satisfied first. You can't convert that RMD amount. You have to withdraw it. 2. If you have multiple IRAs, you don't need to take a separate RMD from each one. You can aggregate the total RMD and take it from a single IRA, whichever is most tax efficient or easiest to manage. And 3, if you don't need the RMD for living expenses, consider directing it to a qualified charity through a Qualified Charitable Distribution, QCD. This satisfies your RMD requirement without counting as taxable income, which can help you avoid tax bracket creep or higher Medicare premiums. Social Security planning is also a major piece of the withdrawal sequencing puzzle. Why? Because it's one of the few sources of guaranteed, inflation-adjusted income you'll have in retirement. And when you claim it, it can affect both your income and your taxes for decades. As stated earlier, delaying Social Security beyond your full retirement age increases your benefit by about 8% per year until age 70. For many retirees, this is one of the best returns available, especially when you consider that it's risk-free, inflation-protected, and lasts as long as you live. And for married couples, delaying can also increase the surviving spouse's benefit. But there's a tax angle too. By holding off on claiming Social Security, you create a window of low income in your 60s, often called the gap years. This is a golden opportunity to do Roth conversions at a lower tax rate, harvest capital gains, or draw down traditional accounts before RMDs begin. And once you start Social Security, remember that up to 85% of your benefit could become taxable, depending on your other income sources. So it's not just about when you claim, it's about how your Social Security income fits into your broader tax strategy. Bottom line, understand that coordinating your withdrawal sequencing with your RMD timing, Roth conversion strategy, and Social Security plan is quite important because it can have a significant impact on your taxes. Step 5 to building your safe withdrawal strategy. This is obvious, but review and adjust your strategy every year. Withdrawal should not be a set it and forget it plan. It's a living, breathing strategy that should evolve with your financial situation, market conditions, and personal goals. So every year, set aside time to review your full financial picture. Look at your portfolio balance, current spending, tax bracket, and life events. Some recommended questions to ask yourself. Did my portfolio go up or down? Do I need to adjust my withdrawal rate? Am I approaching an IRMA threshold? Can I still do Roth conversions this year? Do I need to refill my cash buffer? Are there opportunities for tax loss harvesting or rebalancing? Have my RMD calculations changed with age or account growth? Are my account allocation, cash, bond, stock still aligned with my time horizon? Is my Social Security plan still on track? You should also review your current year tax estimate and projected marginal rate. If relevant, your estimated Medicare premiums, and any changes to federal or state tax laws that may affect your strategy. Even a simple annual checkup can help catch inefficiencies before they compound into bigger problems. And understand that withdrawal success is not just about having a good plan. It's about keeping that plan in sync with reality. So make your annual review a regular part of your financial calendar. Thank you guys for watching the theme of retirement. If you want to learn some myths about retirement planning, please check out my video here. Until next time, all the best.